All right, welcome friends, welcome to this DeFi house idea of how can DeFi help you build financial sovereignty. And this is not about financial freedom through luxury lifestyle, flexing all of those scammy looking type of operations. Okay, I'm speaking more from a philosophical slash spiritual perspective about the financial sovereignty of just living a happy life, being responsible for your own decisions when it comes to money, being able to generate your own cash flows and income using decentralized financial protocols and upcoming whole structure of the financial systems. So the core idea is actually really simple. You do not only hold the assets. This is the very passive and retail based strategy. Buy, hold, and wait. This is what the majority of retail investors do. They buy, hold, and wait for the price to go up. And they live through the bull market conditions, the bear market conditions, the sideways market conditions without actually any growth of their initial assets, but they go through extremely high emotional roller coaster, right? Because you bought some assets, they went up, everyone said it's going to go up more, so you held, then it crashed, then you've been upset and sad because you were able to sell at a highs, but you didn't, so you are waiting now, sitting underwater in a loss, waiting for the price to recover. This may take weeks, months, years, right? So this is the most passive strategy: buy, hold, and wait. It works, but it's not giving you any benefit besides emotional pressure, kind of damaged nervous system, and no additional income sources or ability to use those assets. While the real operation is, and how the whole world of rich people, financial markets, financial systems, banks, investment banks, managers, etc. operate, they never just buy and hold. They buy, hold, and borrow against them, against their assets, theoretically creating leveraged positions. But if you are smart about it, there is no risks involved that heavily if you are smart about your positions. Okay, so yes, without any risk is impossible to generate yields, so to speak. Even the risk-free rate in the US, well, it's still technically a financial instrument that may fail. The probability of that is super low, but the probability exists. So I'm not saying that DeFi or whatever is fully risk-free, no. But if you fully understand how to operate in this world, understand the strategies, and follow strict psychological routine, so to speak, you are able to live a fantastically balanced life and generate all of those yields and build your treasuries, etc. through DeFi. Okay, so the operator way is to own the assets, deploy the assets, and reinvest the assets back to the engine so you keep on growing. Okay, so DeFi in one simple sentence would sound like decentralized finance lets your assets work without leaving your control. This is what I mean by financial sovereignty, not financial freedom, because you can invest your money to some sort of a funds. You can invest your money in specific places where other people are managing your money and making the returns. Fine. And if they're making and doing a good job and you have big enough capital that the income from those places covers your expenses, you are financially free. But are you financially sovereign? In most cases, the answer is no, because financial sovereignty means that you are under control of your assets. So when you operate in DeFi, decentralized finance, you are under your own control. Yes, this gives a bit more responsibility, but in exchange, you have the full control and you can operate like a small country, like a small economy. You are doing everything yourself. So that's why doing it blindly can destroy you. Doing it smartly can make your country a really, really successful economical engine, right? So you have the wallet. With that wallet, you are under control and you have access to all the suite of decentralized finance protocols. You can lend your assets out and get interests just like the banks do, right? You can borrow against your assets and deploy borrowed capital elsewhere, fund your other ventures, invest somewhere elsewhere while maintaining your initial assets exposure. That's the same what rich people do. They borrow against their shares and buy different companies, businesses, etc. Nobody needs to sell anything. Plus, it's the advantage for your own, because you are not selling anything, you are borrowing, and borrowing in 99% of cases is basically tax-free as well. So that's another benefit for that. You can also simply trade. You can buy and sell assets, you can try to catch some nice movements in the markets, or you can provide liquidity and be on the other side of trading. So you let traders trade by providing liquidity, so you don't need to guess the market direction. You are getting paid from the fees either way. Now, the engine for financial sovereignty in DeFi is that your capital must move in a circle. So you own the assets, you have a treasury, Bitcoin, ETH, whatever, XRP, Solana, whatever you hold, right? Maybe even stable coins can act as your treasury under the right market conditions. Then you have to deploy the assets. So you either deploy the treasury assets or you borrow against your treasury, and you have to deploy them to the DeFi suite of areas where you can generate yield. This could be a different funding, different stablecoins, funding protocols, liquidity provision, leveraged exposure to assets, etc., etc. Multiple ways to generate yield in DeFi, right? And then whatever you generate, you reinvest. So you grow your initial treasury. And the core idea is that you can grow your initial treasury not by only value, but by quantity. And using decentralized finance and liquidity provision, I will explain that in a minute, you are able to grow each day the amount of quantity, the amount of coins you have. Not the value, not only the value, but also the amount, because whatever you earn from liquidity provision, you earn in the underlying asset. So if you have Bitcoin and you borrow against Bitcoin in stablecoins, right, and you deploy the borrowed stablecoins into the Bitcoin liquidity provision pool, you earn the fees in Bitcoin. So you can then use the earned fees to feed it back to the lending protocol, back to your initial treasury, and with time, through the compounding effect, by increasing your position size, by borrowing slightly more each time, you are able to generate a flywheel effect with compounds that actually grows not only your value, but also the quantity of the assets. Most people, when they just buy and hold, let's say S&P 500, they bought some S&P 500 fund units and they hold it. Yes, the value is increasing, but the quantity does not. You are not getting more S&P by holding just S&P. You have to yield from somewhere to be able to then redistribute the earnings and get more of the S&P, for example. And this is already possible on chain through the tokenized S&P exposure, but it's not about that in this video. It's about core idea about how DeFi can be financial sovereignty tool. So let's move forward, and I will cover this slightly more in detail in the following slides. Now, the liquidity pool is, you can look at it from this perspective. You provide the inventory that the traders pay to use. So we have the liquidity pool. Let's say the pool is ETH and USDC, two assets, right? Then all the traders that are buying or selling ETH to USDC or USDC to ETH, they are using the liquidity pool that is funded with capital by people like me, you, all the DeFi investors, right? So basically, every single trade costs a fee. So the traders that are buying and selling, they have to pay a fee on every single transaction. That's how DeFi works. The same applies to centralized exchanges as well. Coinbase, Kraken, Binance, whatever, right? When you buy a crypto from those exchanges, you have to pay a fee. Same thing applies on DeFi. The fee is much smaller, and of course it's on decentralized area, but the fee still exists. The only difference is that the fee goes to everyone that provides liquidity and no longer just to the exchanges, the centralized authorities, right? So you have the ability to provide liquidity, and if you are smart enough about the way you provide liquidity, because there are endless ways how you can actually make a very successful strategy or mess everything up by using the wrong wrong pools, wrong fee tiers, wrong deposit split, range size, etc., etc. But by making everything professionally and smartly, you are able to actually simply provide liquidity, let others trade, because you don't take any directional bias, you don't care. Market can go up, down, sideways, you are still getting paid as long as people are trading in that pool. And because everyone is trading every time, the trading never stops. So the fee flow also never stops if your strategy is good enough, right? So you don't care about the market moves, up, down, sideways. Yeah, of course, you have to position yourself professionally not to care about the market moves. Otherwise, if you make bad decisions at the initial deposit time, you could actually suffer from what's known as impermanent loss, where the market is dropping down, and because you provide liquidity into the pool, that one side of the pool is volatile. If is going down, your position value will also go down. Not that much as the ETH itself, but still, if your position is not maintained and deployed well based on the current market environment, you could technically have a negative effect on your position. This applies to, well, all the markets, right? It's difficult to make money if everything is going down, and it's super easy to make money when everything is going up. But in DeFi, it at least allows you to control the downside if you approach the market professionally and not with a greedy needs to extract the max amount of fees with the smallest possible ranges and just live out of the yield. This may work for a week, but definitely not for a long-term perspective unless you understand the whole lending and borrowing provision, so you can position the strategies accordingly. But I'm not going to go too deep into the technicalities because this video will be 7 hours long. I'm just explaining you the very core basics of how DeFi works and how it allows to use all the protocols for financial sovereignty. Now, there is a thing known as the concentrated liquidity provision, okay? Before we had full range positions, so you just deploy to liquidity pool, that's it, your money is working with the infinite price scale. So whatever the asset price is, it can go to zero, it can go to $10 million per coin, you are still earning the yield. But essentially this created a problem where if most of the trading happens within a specific price range for a specific period of time, your capital is not efficient, right? Because it basically stretches from zero to infinity. So the next generation of liquidity pools were developed by Uniswap first, and then the whole idea happened across the whole DeFi. You choose where your capital works, and this is what allows to build a really systemic and professional DeFi strategies, because now you can select in what kind of area, a price range, you want to deploy capital into. So the smaller the range, the more fees you will get, because your capital is more concentrated only towards that specific price range. The bigger the range, the less yield you will get, but you will also get more price room to breathe. So this allows you to keep your position in range for longer, because if you get out of range, you are no longer earning the fees. So you will either have to wait for the price to go back to range, or you have to close the position and reopen a new one with a new range. So this already creates endless amounts of strategies, what kind of range to choose, what's the split size, deposit size, etc., fee tier, etc., just to understand how to position yourself in the smartest possible way. So the lending comes from the easiest way of getting first interest on chain, but it also allows the ability to borrow against your assets to then build this whole flywheel effect of you have the treasury, you borrow against it, you deploy borrowed capital to the yield-bearing assets or liquidity pools, and then you keep the yield and reinvest it back to your treasury, so you always grow the treasury amount of coins, not just value. So your idle asset that you are simply buy and hold and wait becomes someone else's working capital, because now you can supply the assets to lending markets, and the borrower that borrowed against that pool of assets is paying the interest. This is a separate thing from the liquidity provision. This is lending markets, right? So it's the easiest way to get your first yield on chain. Supply the assets to lending protocols and you are already earning the yield, right? It's the easiest way. And the key idea is that all DeFi protocols are fully permissionless. Nobody can tell you, no, you cannot deposit, or no, you cannot withdraw, or no, you cannot get the yield, or something like that. You are under full control. It's always up to you when to deploy, when to withdraw, and what to do with your capital, right? You can deploy right now and withdraw in the next 5 minutes or after 3 years. You can repay the loans that you have in full in 5 minutes in 3 years. Or in parts, in full. You can repay $1 every day, or you can repay full amount after 3 years. No monthly commitments, no documents, no checks, no everything. It's fully permissionless DeFi protocols, okay? That's why it allows so much ease of operating in a decentralized finance space, and also unlocks incredible opportunities to people without banking systems, to people around the world. All they need to have is a wallet, right? And this is where the next gen money, the financial system, is going. It's moving on chain. Tokenized assets, tokenized equities, funds, real estate, everything is moving on chain as we speak. So you cannot be blindly left hanging by simply going to your broker account, buying S&P there, and simply waiting for the S&P to go up. This is the old kind of stuff, right? You have to start adapting yourself to this new digital economy. It's happening whether people like it or not. Now, borrowing side. So your treasury that you supplied as lending, as liquidity, now can unlock capital without selling the core asset, right? So if your treasury is, for example, ETH, you just bought a bunch of ETH, or you are constantly buying ETH and you are keeping this as a treasury. If you keep your ETH as collateral in the lending markets, you then are allowed to borrow against your collateral. In most cases, most protocols, you are able to borrow up to 70 to 80% of your provided collateral, but this is the core maximum and should never ever be done. The maximum amount you can borrow against your collateral should be no more than 30 to 40, maximum 50%, if you really understand what you are doing, if you really are able to monitor the markets on a daily basis, and you truly understand how DeFi works. But the safest possible bet is to borrow 20-30% of your collateral. In this way, even if the market drops hard and quick, you are still able to cover your loss or add more collateral to avoid any liquidation. Because what happens? Yes, you get all the benefits of unlocking by unlocking your treasury assets, and the major benefit is that you are able to borrow against it and use the deployed capital elsewhere, right, and get additional income while you fully maintain your fully ETH, because you never sell the ETH to get stablecoins. You keep ETH as is, and if ETH is going up in value and you have a USDC borrowed, if you repay your loan, you are able to withdraw your fully the whole amount of ETH without any problems, and you keep the price exposure. So if it goes up, right, after a year, 2 years, whatever, you maintain that full exposure. Versus if you sold ETH to USDC to buy something else or to reinvest somewhere else, then you initially sold ETH. That's it. Now you have less Ethereum. So you keep the price exposure, that's the main benefit, but you add the risk of theft and liquidation. And liquidation happens if, for example, you left $10,000 worth of ETH as collateral and you borrowed, let's say, $7,000 from your maximum borrowing limit, right? So you left 10K and you borrowed 7. And let's say ETH started to go down massively, right? So your collateral value, because it's left in ETH, will start to go down as well. So the protocol, the DeFi protocol, needs to protect the lenders and needs to protect itself from bad debt, so to speak. So what they do in such cases is the liquidation procedure. If your collateral value drops below your debt, not even below, but if it's really near the threshold, which is usually about 90%, if it's near the threshold, the protocol will automatically sell your ETH to cover your debt, right? So this way, the protocol will protect itself from bad debt and protect all the lenders as well. So that's what I mean. If you borrow maximum amount, or a tiny ETH drop in price can actually liquidate you. Yes, you will keep the USDC because, well, it's already in your wallet and you just lost your ETH due to the liquidation, but still you will be in a net loss. So theoretically speaking, it's better to maintain a good position health and always monitor whether your borrowed capital is safe, so to speak, right? Now, how the whole idea of growing more balance looks like. So you use real cash flow to buy more of the asset that you want. So for example, if you start initially with 10 Ethereum as your treasury, you borrow against it and you redeploy it to the liquidity pools, right? You are earning the yield, APR, whatever. So after some time, from the fees, you may actually earn 0.3 ETH more. From the interest by supplying the asset, you maybe earn 0.2 ETH more. So at the end of the month, for example, just theoretically, you would have 0.5 ETH accumulated through yield-bearing assets and provisions and pools. So then you get that 0.5 ETH and you reinvest it back to the start position. So now you have 10.5 ETH. So you unlock a little bit more borrowing power. So you borrow slightly more to redeploy back to the same liquidity pool. So you increase your position size. With the increased position size, you are now actually yielding more money per same amount of time than last week, for example, or last month. So this keeps running and this keeps growing your position size and your treasury. Of course, it's all dependent on the market conditions. If market starts to go down massively, you have to react and you have to either hedge your positions or close the positions and wait out for the market to settle down and then redeploy the assets back into the market. So sometimes the first few months or 6 months, even the whole year, if you catch the wrong market conditions, may actually be negative for you. Net P&L might be actually red if you catched and deploy capital exactly before the bear market conditions. But if you understand the psychological patterns and you are not worrying and you are not doing dumb mistakes moving forward, then you are able to recover the capital through the next few months, next year or so, and basically keep everything as is. The only thing is that you cannot allow human emotions and psychology to interfere with the actual sovereignty strategies. Okay, so all of that may sound complicated, and it kinda is on a way, but that's why my YouTube channel exists. I try to teach everything as much as I can. That's why DeFi House exists. We teach people there everything there is to know about DeFi, how to actually deploy the capital professionally, smartly, what kind of strategies do work, what doesn't work, etc., etc. So that's why we try to take good care of our community members. So the treasury flywheel is simply build assets that help build more assets. So you have the treasury. From the treasury, you're able to get more assets. You increase your reserve assets. You can use the productive positions through the liquidity provision, etc. And you can build cash flow depending on what you want. Maybe you want to grow your position size. Then you use one strategy. Maybe you want, you only have stable coins and you want cash flow to live out of it. Then it's a completely separate strategy. You need to protect your capital. You cannot allow yourself to have big and permanent loss. So you have to redeploy capital in different ways. You have to hedge or use delta neutral positions. So there are lots of different variables when it comes to understanding what's your goal of the DeFi, right? So the growth only exists when income beats the leaks. That's also important to know. Yes, you can generate fees and interest, but you will also have some costs or losses. So fees and interest minus cost and losses, that's what is your real growth. So depending on the goal of your DeFi ventures, it will depend what strategy to choose. If you just blindly follow and just open up the protocol, oh, I see this meme coin pool, it's paying 300% APR for a small range, and you deploy capital there, yeah, you might enjoy your life for about 7 hours, but later on you will get hurt and back to reality by the impermanent loss and position value changes. So if you don't understand that, you will get hurt. And that's why most people in DeFi say that DeFi is a scam or it's a nonsense, it's impossible to make money, because they don't understand the core ideas how DeFi works. You cannot blindly jump into all the pools and expect to make easy profit. You need to use your head, your brain, and math to understand these things professionally, right? So the final sovereignty is that you become the operator of a small independent economy. You are running like a little country, so to speak, because you have the reserves that you have to protect. You have the income that your capital produces. You also have debt, as all the countries and economies do. So you must control the debt. You cannot let it get out of chaos. You cannot let it go out of the mind, and you just have to control how you manage the debt. And of course, then you have the policies, the rules you refuse to break, the strategies, the psychological strategies, etc., that you are following to maintain a healthy economy, right? So freedom is not doing anything. It is the understanding of what you are doing, how you are operating, right? Because you are under control when it comes to DeFi and financial sovereignty. So that's what DeFi House is doing. We teach you to become the operator. Liquidity pools, yields, borrowing, risk, the whole treasury construction, everything. You have to grow the knowledge first, and then you will be able to grow the treasury, not the other way around. So if you watch all my previous videos on YouTube, you will learn enough to start understanding the core ideas yourself. You can try out DeFi House. Maybe it's not for you if you are not vibing with my style of teaching, these long unedited raw videos. Maybe you don't like it. Maybe you need action, and some lifestyle proof or whatever. Then it may not be a good match. But if you vibe with me, if you understand what I say, if you like my thought process, then I think it's worth trying out being inside the DeFi House, because there I and my colleague and other community members are sharing lots of different value resources, strategies. Everything is in so much detail, hours and hours and hours of content for you to watch and understand where the financial system is heading, what's happening, and how to utilize these opportunities at the best possible way. So thank you for watching this one. I hope it was beneficial. If you watched the whole video, congrats. I really appreciate you. And as always, I will see you on the next video, and I wish you all the best for the weekend.